Welcome to the webinar From Scorekeeper to Value Creator, Creating the Data Foundation for Economic Profitability. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our discussion. First, we'd like to thank Workday for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Workday. We appreciate you joining us today. We welcome you to stay connected during today's event. For those of you who are active tweeters, please follow us on Twitter at Argyle Exec Forum. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. For those of you who are seeking CPE credit today, you must answer at least 3 polling questions and remain on the session for its duration. Polls can be found under the Polls tab on the right-hand side of your console, right next to Chat. Afterwards, if you're eligible to receive credit, you'll receive an email with a link to your certificates. If you have any questions about credits, please email cpe@argyleforum.com. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Before we begin, we'll have our speakers introduce themselves, and then we'll begin our discussion. Scott, over to you.
Thank you so much, Eric. My name is Scott Moyer. I am a director with Workday's product marketing organization, also a recovering CFO myself, and a former managing director with PwC. I am so excited about this topic, moving from scorekeeper to value creator. And what we mean by that is finance actually playing a role, coming off the sidelines, not just tracking the value of the team, but getting on the field, on the pitch, and helping create value for the organization. We're going to get into that in just a minute. But first, I have a fantastic set of colleagues here I want to introduce you to. I'm going to let each of them introduce themselves, starting with Matt House from Aon.
Hi, I'm Matt House. I'm, as it notes here, the global CFO for commercial risk at Aon, which is essentially our insurance business. Aon is one of the global providers of risk management and wealth management services. So it's a pleasure to be here today.
Hi, I'm Ash Noah, and I work for the AICPS CIMA, and I'm responsible for the Office of the CFO and Finance Competencies. I and my team, we design and deliver learning and certifications to finance professionals. And one of the things we're really focused on now is moving finance and the teams to really towards the value creation zone. So I'm really excited to be here as well and join you all. Thank you.
Scott.
Hi, I'm Scott Schweitzberg. I'm an associate partner in the New York office of McKinsey and Company, a global strategy consultancy. I'm part of the strategy and corporate finance practice, and I focus on how can we generate insights at scale and how can we take them to our clients in more interesting and novel ways. So excited to be here and talk to you guys.
Thank you guys for joining. As we get into this, we may have some forward-looking statements from Workday, so please be under advisement under our safe harbor agreement. So what are we talking about today? A couple of statistics for you to think about. The S&P doubles in value every 7 years. That's amazing, right? That means collectively, on average, the stocks inside the S&P are doing the same. But the average tenure of a CFO is about 4.7 years, almost 5 years. So if you want to be an above average CFO, logic would have it that you've got less than 5 years to double the value of the company. And if you strip everything down that's on the plate of the CFO or the office of the CFO, that is the ultimate job, is value creation. So we wanted to talk today about really how do we accomplish that. So to do that, we're going to start off with Scott from McKinsey. And Scott, I'd like you to kind of walk us through a nice article on the McKinsey website called The 7 Key Value Creation Mindsets and Practices for New CFOs. But these would apply, I hope, to all CFOs, new or old. So Scott, take us away and explain sort of the mindsets here.
Absolutely. A couple of interesting level sets. First of all, the number of functions that a CFO is responsible for has increased from 4 to 6 in the past 7 or 8 years. We're also seeing CFOs play a much more larger role in digital alongside kind of the more traditional things like budget and risk and planning and things of that nature. The other really important factor to bear in mind is that CFOs are also responsible as leaders of their finance function. So what is the talent? What is the way in which they will engage with other C-suite colleagues? And how do they build their teams in order to pull off the myriad of things, 7, as you can see here, that they have to go accomplish? So there's more on their plate than there's ever been. But the North Star of I'm the CFO and I'm responsible for driving value creation is no different. The other big difference, though, as we think about this, is there's just more data. There's more stakeholders. And so how do you cut through the noise? How do you focus on what matters and actually drive towards that goal of value creation? As you can see on the screen, and you don't need me to read the chart for you, but we have 7 things that we've identified from a mindsets perspective that really matter. The first one is scoping the challenge. So understanding what is it I need to accomplish? As Scott was just pointing out previously, what does it mean to go and double in value in the next 5 to 7 years? How am I going to go do that? And what will it take from a resourcing and moves perspective to go do that? I think the second piece is around bias towards action. In order to do this, you are going to have to do something. It's unlikely that just business as usual is going to get you where you need to be. It's worth noting, and we have a chart later on this, that the outcomes on average are double, but they are very uneven. And so how do you make sure that you're in the top performer side of that equation and not the bottom? The other piece that's really important as you're thinking about all this is getting your data right, so that you're actually making smart choices. When you're not taking action blindly, you're taking action in an informed way, and you're making space as you think about that and understanding here are the things we're going to do to drive business as usual, and here are the bold bets that we want to make, and what does that look like? That also means thinking about your the portfolio, thinking about it as a portfolio. Not everything's going to work out. One of the things that we found when we were talking about mindsets of CFOs is one of the biggest risks you can take is taking no risks at all. And that becomes a really important factor, is having the right data, having the right approach, and taking calculated risks as opposed to just blindly taking risks. I think there's another piece here around ESG. You need to be thoughtful around what is the footprint that you're going to have. How are you going to think about governance and sustainability in that context? And then lastly, and we cannot stress this enough, your team matters. And how are you going to build your team both directly and indirectly around having the right group of stakeholders and supporters so you can go and achieve this wonderful set of things that we've just talked about. If you want to do something big, the likelihood that you can do it alone is effectively 0. So how can you go do that, and how can you build the right set of folks to go and accomplish that?
Matt, you're the only CFO actively on the call here today. Do any of these resonate with you?
Yeah, I mean, a couple of them in particular. I think given that I work at one of the larger risk management firms in the world, I'd probably be remiss if I didn't mention that being proactive around risk. We absolutely eat our own cooking there. So we think a lot about understanding the risks, measuring the risks, mitigating them to the extent we can. And then if we can't mitigate them, it's okay, how do we manage the risk and transfer it where that's appropriate? And we do that both in the property and casualty space, D&O, kind of more traditional areas of risk transfer, but also we're starting to think about that in terms of intellectual property, right, which is today largely uninsured, largely unmanaged in terms of the valuation risk around that, but also areas like climate, which is kind of hits on the ESG bullet. But further, I think the making space in the portfolio for a few bold bets, I mean, that's something that Aon has been very intentional about over the last 10 to 15 years. That I would say the Aon of old was very, kind of let 1,000 flowers bloom, and some of them will, turn out to be really outstanding businesses. Today, we have an Aon United strategy where we kind of look at the entire firm through one common lens, which, as we'll talk about later, is a return on invested capital lens, and think about, okay, where can we make very deliberate bets that are going to deliver maximum value creation for the firm. Like I said, that's been a journey, but I would say over the last 3 to 5 years, it's really kind of come into focus and is absolutely the way that we think about capital management at the firm today.
It's I like it that you think about this as a portfolio, Scott and Matt. If you think about the job of a CFO, we're given capital to allocate inside the firm, right? It's almost like an investment manager of a small portfolio of companies, and you've really got competing needs for that capital. Where do you place it? Where do you place those bets? So really putting that portfolio mindset around there. When we think about these are mindsets, but it's probably easier to think about value creation with a model of some sort. So for that, we're going to bring in Ash and kind of talk about a model that the AI-CPA has done. Ash, why don't you introduce us a bit to the concept of this group you have at the AI-CPA, this that we'll get to here, the Future of Finance Leadership Advisory Group, of which Matt is one of the members. Tell us a little bit about the goal of the organization, and then let's get into that finance assessment model for effectiveness, also known as FAME. But let's start here, Matt.
Thank you. Yeah, thanks very much. The whole idea of the finance assessment model for effectiveness is about measuring how effective is the finance function in terms of moving towards that value creation and truly leading the organization towards the future. Now, this group of people you see there is a snapshot of some of them. There's about 100 leaders from Fortune 500 companies. You can see some of the logos, but of those 100, a few select are in the leadership group. And the idea is really for this group to chart the future of finance and really reimagine finance for the future as to what it might look like. And I'm a former CFO, and I've been with the AI-CPA CIMA for 10 years now. So I've not been an active CFO for 10 years, but all these other folks are actually practicing CFOs, and what they bring to the table is what is currently going on in the finance function. Where are these CFOs taking their finance function? So it really is a peer-led agenda, and it's a peer-led group. The agenda is set by the CFOs, not by AI-CPA CIMA. We are just convening them. But these leaders wanted to really chart the course for the future of finance. No offense to any consultants, but they wanted their own view of where should they be taking their functions to. And so when we started talking about value creation, and we started talking about, this whole idea that we are not just scorekeepers providing information, but we are actually co-pilots, kind of generated this idea of, okay, let's try and measure where we are and where we want to get to. And 15 years ago, so when I was still CFO, I had about 45 countries globally, and we were on a journey. And so this is not new. We've been on a journey to not be the scorekeeper. And my strategy was called moving from scorekeeper to business partnering. But now you can see it's beyond business partnering. We're moving to value partnering, and then really moving to a future state where it's aspirational. But what these CFOs are saying is that's what they want to get their organizations to. So yes, Scorekeeper, we all know that's about reporting, that's about getting information curated, reporting, analyzed, insights generated, etc. But once you generate the insights, then you're an advisor, you have adequate understanding of the business. But then when you start to truly partner with them, that's when you start the journey of co-creation. And partnering is more around having those strong analytical skills, really strong understanding of the business. But then when you start executing, that's when you are in the value creation zone. And the mindsets that were mentioned before very much play into this zone of value creation, where you are providing proactive, unique insights that you're then able to actually implement. And the futurist is leading being a part of the enterprise, where you're saying, this is where we're going as an enterprise, and you're innovating your business model across the entire business model, and you're operating across the entire value chain. Now, that the starting point was to try and identify where are organizations and where do they fall, and we'll have a polling questions around that. But we polled our group of 100, And what we found was predominantly you have people in that middle. They're all moving towards business partnering and want to move towards value creation. There were some futurists in the group, and there were some scorekeepers. And this is the great part about the group. There is candid feedback. Everyone's honest. These are meetings where they're closed doors in terms of we don't publish our findings other than what is agreed. And so it's a really candid conversation with challenges, how companies are addressing those challenges, how CFOs are addressing the major challenges, etc. So what you can see from the next slide is this is what led us to the 5 dimensions. And these CFOs came up with 25 sub-dimensions, which were grouped into the 5 main dimensions. And these 5 main dimensions were also confirmed in our surveys and our research. Around 2,500 CFOs in about 50 countries across the world in all the markets basically agreed with these 5 dimensions that CFOs should be looking at. And technical skills is obviously what brings finance to the table. But beyond technical, we're looking at the digital aspects, the business partnering aspects, the people management, talent development aspects of the finance function, and then finally the leadership aspect. So these 5 dimensions and these 25 dimensions are broken down further, and we'll be launching a tool in partnership in partnership with Workday, and that tool will be provided eventually for you listeners if you want to engage in assessing where your organization is. It's a guide. It's not very precise, but it directionally will tell you where you are. So when you look at this 5 dimensions and you look at the progression from being a scorekeeper, collating information, curating reports, and producing insights, then going on towards using those insights to communicate them effectively, influencing the organization, collaborating with your cross-functional colleagues, and then really creating impact and creating value. That's the value creation zone. I'm not saying the last 2 circles are the only zones where value is created, but that's where predominantly CFOs are wanting to move towards. And the essential part of moving towards that value creation is to have that digital enablement, the systems and tools and data and automation, and the readiness to transform, and really using those tools to automate business processes, to look at your legacy processes and really transform them into being able to leverage automation, being able to leverage ML and AI, machine learning and augmented intelligence, artificial intelligence, etc. So the use of tools in the technical and using technology to automate really enables one to move to the right. As you automate more and you equip your people with the skills in leadership, in driving business and driving your business model, then you're really moving towards value creation. So that's really what we are talking about in this tool. And these sub-dimensions, we'll be going into 2 of these sub-dimensions in the digital dimension later on in the presentation.
Before we do that, though, there's a lot to unpack here, Ash, and we don't have time to go through all 25 or so. Could you highlight the ones that kind of are most relevant when we talk about value creation?
Yeah, we've already talked about generating those insights, actionable insights. We then look at really leveraging data, being involved in the strategy, in driving strategy. Stakeholder management has been mentioned, especially when you go towards the wider sustainability discussion. Stakeholder management is absolutely critical. And then having that bench strength of talent, being able to communicate and engage with these stakeholders, and then truly driving performance and results. So what you will be hearing in terms of value creation, there are some major shifts that are required to be made by finance. And these have been spoken before by Matt, but I'll just word them in slightly differently in terms of, if you're creating value, we've got to move from tangible to intangible asset management, because if you look at S&P 500, only 10% of the value today is in the tangible assets. The other 90% are in the intangible assets, such as intellectual property, and that's not in the balance sheet. This is intellectual property, which is intangible. Your intangible assets, as in your people, the whole human resources is an intangible asset. You've got intangibles in natural resources, but it's not applicable to everyone. But human capital, your intellectual capital, your natural capital, these are the intangibles, and there is a need to move towards intangible capital management if you want to create value. That also requires us to move from short-term to long-term. So it's not just about the profits for this year, but it's about long-term cash flow generation, making new connections, and you need data and digital transformation readiness to make connections between data points and joining the dots. And then you need to move beyond just cost and revenues into the other parts of the business that we've mentioned. And when you look at the business model, we predominantly spend 90% of our time in measuring, reporting, analyzing insights in costs and revenues. But the value creation zone is when you really truly engage in creating a digital ecosystem that connects your enterprise to suppliers, to other stakeholders. When you are understanding the customer value proposition and engaging in innovation around new products, new ways to serve the customer. I've already mentioned strategy, but a culture of disruption. How can finance really drive a culture of disruption, disrupting yourself and also disrupting the industry? Managing those relationships with stakeholders, not just investor relations, but many other relations, including employee relations and including the relationship with society at large. And then the processes which convert your raw materials to finished products, again, the use of intangibles. So it's absolutely critical when we are talking about value creation, we go outside of the cost and revenue box and start to think about some of these other areas.
Let's go and look at that first. So these are the 5 core dimensions we had. And one of those was digital transformation. And we're going to go deeper into digital in just a second. But why don't you walk us through this, Ash, and when Matt joins back, we'll have him jump in.
Absolutely. So when we're talking about digital transformation readiness, this is not just about the finance function, right? This capability should enable your finance function to drive transformation across that enterprise. That's how the CFOs have defined it. So it's not about finance transformation, but it is about digital transformation across the enterprise. That's what is driving your finance transformation, which you're a part of. So really moving from that basic level of, okay, we've got a limited understanding of our digital assets, to the futurist who are looking at being able to adapt to ongoing, taking in new technology. Generative AI is here. How do we leverage generative AI? It's absolutely essential for an organization to be able to leverage the latest tools and technologies if you want to be best in class, creating value, disrupting your competitors, disrupting the industry. And so that's really what the digital transformation readiness enables you with. And so that dimension is measured on these 5 levels using this as a checklist. When you do get the tool, you'll get these checklists and you can pick what describes you most, and then your organization will automatically be classified, whether you're an advisor or value creator. So these are descriptors, and it's almost sentiment analysis, which will enable us to mark your function on.
But you have to know where you are to know where you're going. So having a map like this is great. Digital transformation readiness really implies a lot to the human mindset and the human element of this, right? That just having the right technology doesn't work if the people aren't engaged. Matt, do you have any thoughts around sort of the people side of this and your readiness to move forward at Aon?
Yeah, so we've, similar to what I was describing earlier, we've been on a journey on this side as well over the last few years. And actually, Workday has been a fantastic partner to us as we've engaged on or commenced on that journey, both on the HR side and on the finance side. So we kind of use the tool on both sides of the house. But having that, and we're going to get to data in a moment, but having a tool that's kind of common across all of our countries, we operate in 90 countries globally, has been really, really important to us as we kind of, engage on this digital transformation
Managing your people
ourselves.
and money in one place. Interesting concept. Let's jump to our first poll question. As we're speaking about digital transformation, so now that you've seen these different levels, scorekeeper, advisor, partner, value creator, futurist, with that dimension, the digital dimension, think about where you think you are as an organization, and we'll give everyone a minute or so to get those answers in. And I think just for the panel here to kind of react real time, it's kind of a breakdown of more than a third in that scorekeeper category, which is slightly different than the polling that AICPA and Workday have done. But this is interesting. About a third scorekeeper, about a third advisor, 20% partner. Not many people say they're value creators or futurists. I don't know. Ash, your reaction to that at all? Is that surprising?
Yeah, it is a little bit surprising as to the skewed numbers towards the scorekeeper. Like I said, we've all been on this journey. Maybe you're being a little bit more brutal on yourselves, perhaps. But when you do engage with the tool, you might find you're more engaged with having a seat on the table and at least advising the business, doing some level of partnering. I think it's very easy to put yourself in a box, but typically people are playing in all the different boxes. It's where you get the most ticks in the tool in terms of descriptors. So you might find you're actually more towards an advisor, but it's good to see the candidness of the attendees to say that, hey, they have a journey to take to get towards partnering and value.
We had a question come in, I think it's relevant, and I'll just ask anyone on the panel that wants to react to it around digital transformation readiness. Who manages the governance and all the compliances, say in healthcare, HIPAA, or whatever regulatory bodies like at Aon? I'm sure you have a large list of regulatory issues you've got to keep in check. As you look at your digital transformation, Matt, do you have a governance body in terms of the transformation efforts that handles that?
Yeah, so I mean, obviously this is dependent on what organization you're at and the way that organization is structured. The way that we have approached this at Aon is we have risk committees that span different functional areas. So you'll have someone from legal and compliance, you'll have someone from finance, someone from operations, and so on. And so, and by the way, Aon operates in highly regulated industries around the globe. So we're very conscious of things like HIPAA, for instance. But yeah, I mean, we have, as I mentioned, cross-functional teams that address this and figure out, okay, here's the compliance requirement or the risk to the firm. Here's what we do to make sure that we address any concerns from a regulator or anything like that. So finance is a member of that team, but finance doesn't own it at Aon. But like I say, that could vary.
Absolutely.
Based on the company.
Thank you for
that.
Typically what is seen is that it's a joint ownership, and it could be a combination of IT, finance, and someone from compliance in a specific industry. But it's never one function on its own. They're usually data governance committees, and these committee members are pulled from the various parts of the business. And I think that's the best way to actually manage data governance. I don't think one function on its own can actually have the right answer and know everything. So you'll find as we move into this whole issue of data, having one source of truth, as in, there's only one set of data which all the business goes to around business and analytics. There's operational data, obviously, but what we're trying to do here is to identify, or what the CFO said, is there needs to be a finance data model that is the single source of truth. And that's how we measure the effectiveness of data in terms of a dimension. And so those that are at the futurist level are obviously leveraging data from a variety of sources. Now, I talked about a shift from short-term to long-term, short-term value creation from the P&L cash flow of this year, and moving towards capital allocation for the future, cash flow allocation, and you know, the very fact that you have to forecast over longer periods. There are companies like Shell Oil that forecast and have models built for the next 30 years. And so that shift to the long term requires the right data models, and also models that can support that type of crunching. Connecting financial and non-financial data in order to measure intangibles is absolutely essential when we look at data. So what I mean here is that they're not measures, financial measures for intangible asset management, but there are proxy data points that finance needs to leverage. So it's all that type of capabilities that you have within finance and within this data set, which enables finance to really enable the organization to make decisions, data-driven decisions, and that speed of data to decision.
Matt, I want to get real practical for a second, because these things can sound like theory. And we have customers at Workday, for example, one of them is a large Jiffy Lube franchise operator. They have found out through the years that, you know, when there's bad weather, people don't change the oil in their car. And so they use weather data in conjunction with their financial data to predict what's the profitability at each store, how many revenues they're going to have. That they can then predict the amount of staffing they need to have, the amount of inventory they need to have down at the store level on an hourly basis. This gets right at the heart of value creation. So when we get into the ROIC calculation in just a minute, you know, being able to take a store level, let's call that an asset, a store, and be able to predict with fairly good certainty what kind of revenues you're going to have and what staffing, that is micromanaging the profitability down to an asset level, which is really the sweet spot, right? Bringing the P&L over to the balance sheet, combining the two to really drive that value. That's really all about, we talk about capital allocation. Matt, do you have any examples at Aon where you're perhaps bringing in non-traditional finance data with finance data, or non-traditional data with finance?
Yeah, I mean, I think a couple of points on that. One is on the financial data and, you know, other data that we're gathering inside the firm. I think it's really important to be thoughtful around the data structure and what level of granularity you need there. One of the things that we've encountered at Aon is, like, you'll track a thing a certain way for some period, 3 years, 5 years, whatever, and then we decide, you know what, we're going to reorganize and we actually want to track it this other way. And making that pivot in some cases has been very easy because we were thoughtful around sort of like what's the, you know, call it the fundamental unit we need to be tracking. In some cases, it was like you basically have to go back and redo the last 5 years to figure out what it looks like, you know, retrospectively, and then how you're going to do it prospectively. So really important to be thoughtful around that internal data structure. On the external data sources, to your point, we've identified, some through academic research and some through our own analysis, that there are a number of macro data points that we can use to help us understand where certain businesses are going in certain geographies. And so we'll use data from like Moody's Analytics or other kind of third-party forecasting firms. Actually, we also use a McKinsey database to help understand where insurance premiums are going, where economic growth is going, and that helps us think about how we invest and kind of stay out in front of demand.
So let's move into that end, you know, that North Star, I think you called it, Scott, which was sort of economic profit and how we look at that. And before we do that, just a quick poll to see how many of you on the call are familiar with the concept of economic profit as a measure of value creation. So answer 1 is no knowledge, tell me more. 2 is some knowledge. 3 is, you know, broad knowledge, understands and leverages the concept of return on invested capital inside the business. And these answers that are coming in are not surprising. I will say, in my career over 30 years ago, I had the pleasure of working for 2 large companies, Siemens and Coca-Cola, both of them, the entire management team was rewarded based on value creation through economic value add, which is another way of looking at economic profit. So I'm almost shocked that has taken, that 30 years later, it isn't as prominent as it was then. But as Scott's about to tell us, it has come roaring back, or at least the best firms that look at tracking value are doing this. So Scott, without further ado, I'm going to jump over to you and have you talk about economic profit.
Yeah. So what is economic profit? In a nutshell, when we think of economic profit, we're basically saying, what is the profitability of a firm after factoring in the cost of capital? And when we look at this and we look at the kind of top few hundred companies, you can see, look, there are lots of whims of the market from time to time and things that change and factors, macro factors at play. But broadly speaking, if you look at where the line starts and where the line ends, there is a long-term correlation between overall shareholder return and profitability after capital charges. And we think that that's quite interesting, and it gives us a lot of confidence in pointing out that when you think of your North Star, building in profitability after the cost of capital is a really great place to start.
And then does it matter if it's a high growth company or a low growth company? Does it matter?
Your overall return will be affected, but the relationship between economic profit and shareholder return holds even after factoring in whether you're in a high growth environment or a low growth environment. So just to explain this chart a little bit more clearly, we broke out the different growth performers into quintiles. So you can see the top quintile is the light blue line and the bottom quintile is the light yellow line. And even after factoring that out, when you look at economic profit growth, you can see again, the top performers on economic profit growth have higher shareholder return than the bottom performers on economic profit growth, regardless of overall revenue growth.
Excellent. So economic profit for the accountants on the call today that are going, this is all nice theory, but what are we talking about? How do we calculate this? So let's get into that.
There's a couple of different ways to calculate this. The easiest or the most straightforward way to think about it is effectively, what is your NOPLAT minus whatever your capital charges are? So NOPLAT's pretty straightforward. It's revenue times margin. And your capital charges, take your overall total invested capital, multiply it by your weighted average cost of capital, and that's your capital charge. There's other ways to calculate this using things like ROIC and looking at, EBITDA times ROIC minus WACC, but this is the most straightforward one.
And that weighted average cost of capital, just for those that aren't familiar, would be weighting between debt and equity. So if you think about it, if you were a private individual that had your own company, and all you did was borrow money at 5%, your cost of capital would be 5%. But if you have shareholders that have a higher expectation than that, let's say 10% is the classic example, they expect a return on their investment of 10%. You got to hit that blended 7.5%. just to break even from a shareholder value perspective. Yet you've got to at least earn your cost of capital. Everything beyond that is economic profit, correct?
And that's why we like economic profit. We think it's a great measure of value creation, right? Taking into account the cost of the capital that you had to put towards it. What did you bring on top?
It's a great measure at the group or company level. I think probably where the devil gets in, is in the details, Matt, around if you go below the corporate level. Has Aon experienced any work there where you're checking the, ROIC?
Yeah. As I mentioned earlier, this is the framework that we evaluate pretty much all of our financial decisions, in terms of the investments we're making. And by the way, when you think about what Aon is a professional services firm, so the good news of that is that we're kind of capital light. So the bottom kind of bracket here is a little bit of an easier lift for us. The challenge there is you're hiring people, and people are fungible, right? Sometimes you hire them and they don't do what you expect them to do and that sort of thing. So we spend a lot of time kind of on the top piece here, really understanding what is the true margin of our various businesses. And we want to make sure that we have a fully allocated margin, sort of with all the corporate expenses and everything else, so that we have a true bottom line view of what our businesses are generating in terms of economic profit. So yeah, we've invested a lot in this over the years. And as I mentioned earlier, this is our primary decision-making framework.
So Scott, if I'm a CFO and I'm a new CFO and I really want to be an above average CFO and, beat the odds and do it in less than 5 years, walk me through kind of how I need to look at the market and how I compare with my peers, and how do I get into that upper end of this curve? Maybe explain this curve briefly to us.
Yeah, well, I think one of the neat things when you start looking at something like economic profit is you can start to compare yourself on a global scale. So rather than thinking about, am I outperforming in my industry? Am I outperforming versus my small set of peers? What does it look like when I take a step back and say, here's a common metric I can use across any company, and just ask myself, how am I doing? And one of the things that we found is that if you look across thousands of companies, you'll notice a couple of things. One, most companies, the second, third, and fourth quintile, are just kind of hovering right at the edge of their cost of capital. They're basically neither creating nor destroying value, like destroying with a lowercase d, like intellectually. You'll also notice that the kind of value destroyers are heavily concentrated. There's a small number of companies that are very, very, very large and consistently delivering returns below their cost of capital. Some of that has to do with endemic factors relative to their industry. You see that a lot in kind of very commodities-driven industries where it's kind of feast and famine, and when you look at it even on a relatively short time scale, it can manifest. But then on the other side, you'll notice that there is a very small set of companies that are generating a huge portion of the overall value across the top 5,000, and you'll notice that this line starts to increase exponentially. So it's fun to look at this chart, and one of the things that it also starts to help you understand is when you're thinking about economic profit, it does have two components. It has the ROIC component and it has the growth component. So what you see here is, depending on where you fit within these quintiles, you can start to make choices about, do I have a ROIC problem or do I have a growth problem? If you're kind of in bucket 2 or in the bottom, right half of bucket 3, it's really about achieving scale and figuring out what are the things that I can do that are going to be economic profit accretive and build scale. If you're over here in bucket 4 or bucket 5, then the real questions are, what can I do to actually drive my ROIC? How can I actually get out of this rut? Because the larger you get, if you have an ROIC below your cost of capital, the worse you're making the situation.
So losing it on margin, but making that old joke. I can make it up on volume, right? Not so much. Yes. So that looks like the top 20% are adding 90% of the value of the market. And this is a survey over the last 5 years of about 5,000 companies, and I think we excluded companies bigger than 10 billion or more than 10 billion in economic profit and less than 10 billion in economic.
That's exactly right. There's a small set of companies, right, that are enormous by this metric. Some of them are 5 or 6 times above the cutoff of the 10,000. What we found is that it's easy to kind of look at this holistically and kind of ignore some of the outliers for the purposes of the analysis. Obviously, it's fantastic to be one of those companies that's delivering 20, 30, 40, $50 billion in economic profit a year. But it may not be a reasonable aspiration when even just moving from the left side of the top quintile to the middle would deliver a huge amount of value. And
it really matters whether you're a capital intensive company or not. As Matt was saying, if in the services industry you have low capital, you can drive this needle a little bit quicker. Before we move on to, I want to talk in a minute about some of the analysis that McKinsey has done. It's just, you've got a wealth of knowledge around this because of one of the tools you all have created. But before we get to that, we have one more polling question. So thinking about this ROIC concept, the question is, do you as a company have the data and systems to be able to calculate ROIC? And I'm going to add it a little bit deeper, not just at the corporate level. Can you get down to whatever the next level of granularity is for your company? So for example, if you're in retail, can you do return on invested capital by store? If you're in transportation, can you do it by truck? Can you do it by geography or business unit, et cetera? So that's what the question's getting at. Lots of answers coming in. A little over a third, about 40% say, yeah, they've got what they need from a data perspective. That's great. A similar number say no, and the rest aren't quite sure, which makes sense because, as we said, the devil's in the details. When you get into it, you really have to kind of get behind your data sources. Scott, tell us a little bit about McKinsey's tool, CP Analytics.
Yeah, so I guess you could say when we think about this content, one of the first things that we realize is that we want to be able to do this quickly and at scale. So we actually built a platform that we call Corporate Performance Analytics that takes a lot of the work and heavy lifting that we had been doing manually to, kind of comb through financial data and understand some of these factors, making sure everything's apples to apples, making adjustments as needed. A good example being if you're a auto company with a financing arm, how do we account for that? And kind of build a platform that shows off all of the most common value creation metrics and analyses that we think are really important. And we've been using that internally for 5 to 10 years, and now we're just starting to think about how can we distribute this capability more broadly to our clients. We found it's really helpful. The other neat thing you can do when you do this analysis at scale that you can't do on a one-off is start to look at industry roll-ups. So what does it look like when you say, let's look at an industry and say, well, what's the ROIC across 200 or 300 companies?
And benchmarking is revealing, right? Because
Sure.
You may think you're doing a great job as a company, but when you see how you're doing in your industry, it can be eye-opening, just how far your competitors are ahead of you. So it's a great way to level set. I guess the question I have, Scott, is really, that's great. Once I see that, I still want to go into the weeds on my company and figure out, how can I calculate ROIC down to a more detailed level. This is some of the types of dashboards that start at the benchmarking level, but ultimately can kind of get down into the weeds of your actual company. Why don't you just walk us through briefly these, and then we've got a couple of questions that are coming in we'll get to in just a second. Why don't you walk us through this slide first, Scott?
Yeah, absolutely. I think this is one of the neat things, and Scott, is how we started working together. We've been thinking about, once you have all these insights, what are the ways in which you can actually incorporate them to make them as valuable as possible? And so starting with, where are our clients thinking about this stuff? And a good example is inside of Workday. So one of the things we've been thinking about is how to bring our insights into Workday so you can start to get a better sense when you're looking at your data and be able to track and compare some of these things that we found, so you're not flipping back and forth between two screens or calling someone on the phone or asking for trying to side by side two charts. So this is our first effort, is how do we actually integrate our insights into places where our clients and decision makers are, because we are much more excited about impact than we are about running a website, as fun as it is to run a website.
Okay, and then sort of down below there, we've got the industry dashboard, strategic dashboard, power curve of industry, showing you which industries probably have the easiest time doing economic profit. I would guess they're more on the services side. The economic profit power curve. Tell us about the total stockholder return decomposition. What is that?
Absolutely. So one of the things that we like to do when we do some of this benchmarking is it's useful to have the high level metric. Oh, your ROIC is off, or you have lower shareholder return. That's a great conversation starter. What's better is, can I start to understand some of the underlying causes, even just with the data that I have at my disposal? So when we think about shareholder return, we have a reasonably good sense of what are the drivers of shareholder return. We talked about some of them: ROIC, economic profit growth, revenue growth, profitability, overall. So to what extent can I start to peek under the hood when I do some of this benchmarking and say, okay, fine, I'm lagging on shareholder return, but why? And if I think about the 4 or 5 things that tend to be correlated with that, where am I behind, or where am I ahead, so that I can start to do that. Same with the ROIC tree. What we've done there is just taken that calculation and try to break it down so you can get the side by side of saying, okay, fine, my ROIC is below where I'd like it to be relative to my peers. Is that an EBITDA problem or a capital efficiency problem, or both?
Mm-hmm.
If it's an EBITDA problem, is that happening at the top line? Is that happening at the bottom line?
So Scott, a question.
Where am I?
Yeah, I'm sorry to interrupt you. A question came in while you were talking that I think fits here very well, and that is, and anyone can answer this, but I'll start with you, Scott, if you've got a thought. What's the biggest mistake you've seen companies make in trying to find opportunities for value creation, and how do they get past it? Any thoughts on that from the panel?
Yeah, I think there's a couple of things. I think the one of them, and this is a mistake you see at all sizes of organization, right, is magical thinking. Here's the problem, but it's temporary, and I know exactly how we're going to fix it, and all we have to do is get through this one thing or this one product launch and this one mechanism, we're going to be fine. I think the point we were making before about having a portfolio really matters. I think a lot about this. I think we sometimes think of strategy as a ladder. I just need to get to the next rung. What you want is a net, because if one of the things breaks in a net, you can still move around and go and get up to where you need to go. And so that's a big one, is how do you actually have a portfolio of moves rather than hanging your hat on the one big thing? Another piece is, are you looking at the right data? Are you being expansive in what the opportunities are? We talk a lot about adjacencies, particularly when we think about growth. Do you have a good view on what those adjacencies are? Are there non-obvious examples, e.g., where you have a lot of overlapping customers, but maybe it's not necessarily the same thing that you do today? Do you have a lot of overlapping capabilities, but maybe it's not the thing that you do today? So we spend a lot of time thinking about that as well. But usually with a little bit of data and a little bit of imagination and some appetite for calculated risk, you can get through those things.
So it's really not thinking broadly enough. And for CFOs and finance organizations, you talk a lot just now about the market, about revenues, about adjacent markets, and about expanding the pie of potential offerings. That is not typically something an accounting school is going to teach you, to think in terms of the overall growth and the pie. But we have seen customers of Workday use our tools to go. I'll give you an example. We have a media company that had a hit show on one of their networks, one of their markets, and they figured out a way to just take that show and broadcast it amongst their entire network of cities. So, talk about an analyst sitting in a room going, hey, this spiked here, a revenue spike here. Why? Asking the question why multiple times till they get to the real root cause. We just had a celebrity type person in that market that was great, and it was a great show, and they put it on every single market and franchised it. That's not the right word, but syndicated it to all those different shows, and boom, pops in revenue across the entire portfolio. That was a finance person who discovered that, using tools, using analytics tools. So that's really getting to your point about you can go beyond just the debits and credits and get into thinking about the broader marketplace. There was a question that came in that
I think.
Go ahead, Matt.
Oh, sorry. Could I add just one more thing on that? Yeah, I mean, I think, look, like sitting in the finance seat, like you can kind of bring like the speaker of truth role to things, right? And I think just to kind of amplify something Scott was saying earlier, I think one of the mistakes that I've seen a few different companies make is like you get kind of attracted to this shiny new thing, right? It's like, oh, I'm gonna kind of really focus on that. And if you do that at the expense of what's been your core business, whether it's an adjacency or it's an even bigger leap than that, if you kind of get that investment profile out of balance, it can then have a fairly disastrous impact on your portfolio. And sitting in the finance seat, like we bring data, we bring facts to the discussion. And so I think that can really, if you're in a partner or value creation kind of mindset, right, you can bring that to the equation and help your partners understand, right, what it is that, like, what if we make these moves, right, what's the impact going to be?
I love what you said about bringing facts and information to the table as a key role of finance, because data has exploded. It doubles every year, the availability of data, but it's hard to harness it and get it into the right format to make those real-time insightful decisions. And what I've seen in my careers is a lot of CFOs that made it intuitive ability to get without the data. And so there's a whole generation, and I was probably one of them, that were well rewarded for being able to guess without having the data. But now that there's so much data out there, getting it harnessed and captured, I think we're going to see a shift towards much more numbers-based facts and figures, as opposed to gut instinct in our next generation of CFOs. Any thoughts on that, Scott or Matt or Ash? And as you're thinking about that, a question came in that I think probably relates to that, which is, and I'll throw this over to you, Ash. How do you think the CFO discipline is going to evolve over the next couple of years? And I may have just answered it inadvertently, but I'd like your thoughts on that.
No, yeah, very, very related. So the whole idea of value creation stretches the CFO's role beyond the traditional. The idea of allocating the future cash flows to the right projects. We just talked about the portfolio approach. If we use our traditional methods and we use our traditional KPIs to see if an innovation should take place or not, or investment should take place or not. We tend to become the innovation killers, the killer of innovation. And so, yes, we come as the person that knows more, to your point made before. But when you, Matt, but when you really look at how, your value generation is linked to the allocation of your future investments into the right projects, I think that is really fundamental to value creation and to back the right horse in terms of a portfolio rather than one single. And a lot of this data, Scott, comes from the hockey stick growth book, right? And you can see how, it was hit or miss. You either picked the right project and it had hockey stick growth and you created value. But really, it is that understanding of going beyond cost and revenues and going into strategic projects that are going to deliver is what's going to make the difference. And those shifts that are talked about, going into the intangible territory, going into the longer term territory, coming outside the cost and revenues into the other aspects of the business model, that's how it's going to shift. Those are the shifts required for the future.
So Scott, we had one more question. We have time for one more question, and it came in a bit ago related to your 7 points. Can you go into a little more detail about what you mean by a bias for action? And I love this last part. My company's biases are more towards inaction. Maybe a minute on that, and then we'll wrap things up.
Well, I think that there's, I mean, I think the basic way to think about it, right, is kind of working under the assumption that you need to do something. And what you are trying to get to is what that something is. And I think that, to your point on the kind of bias towards inaction, I think that there's another kind of ingoing assumption that sometimes can occupy a folks' minds, which is, should we do something?
Right.
And then you spend, instead of spending your brain power figuring out what that something is, you spend half of it deciding whether or not you should do anything at all. And most of the time, most institutions exist to do things. And it creates a challenge when folks.
And that's perhaps why having something like benchmarking to give you that external kick in the butt you might need to say, I'm not doing as well as my peers, I'm going to need to change something, is helpful. I'm going to,
And looking across a couple of different lenses of benchmarking, right? There's my peers, there's the overall power curve view that we were just talking about. It's looking at different dimensions, whether it's around calibrating your growth, calibrating your profitability, calibrating your economic profit, other factors like your org, the activities you're engaging in, innovation, really kind of taking that lens of saying, where am I behind? Because all of these things factor into
Absolutely. We've only got a minute or so left. I just want to do a couple of quick housekeeping items. We will have, as a follow-up to this, the webinar recording that you can share with colleagues. You will get a copy of the AICPA CIMA FAME white paper. That's that model we talked about, the finance assessment model for effectiveness. So you can look at that yourself and see where you think you stand in terms of the different dimensions. There's a value creation demo on our website that you'll have a link to with that very good looking guy there on the right. Just kidding. Don't forget Workday customers. We've got Rising coming up last week of September 26th to the 29th in San Francisco. So please join us if you are able to. And finally, with our friends at MIT, we talked a lot about AI and ML and some of the less intuitive and more data-driven type decision-making tools that are out there. We're teaming up with Workday and MIT to offer a certification class. So you'll have access to that to register. It's a very exciting program with our colleagues. But finally, I just want to thank our panelists so much, Matt, Scott, Ash, for all of your insights today. It was a great show, a great presentation. And please, if you have any other questions, you can submit them in after the call. And thank you all very much. Have a great rest of your workday.